and thanks for liking my article. I don't know if you read it, but it's not easy to read. All right, let's see. I'm just trying to find a presentation. Do you want to do last week's or start with this week? This week.
This one will be
Right.
I think it has a recap.
Okay. It's fall 2024, I think.
Summer 2000.
Summer 2024.
Oh yeah, this was
Yeah, this is the one.
Summer of 69. Good.
Oh, one of these, right?
But I should maybe done first yeah, lecture 4.
This one?
This next one.
PPT.
Yes. Pretty low attendance.
Yeah,
today.
How much attendance?
Yeah, I called them probably they're just on the way.
They're on the way?
Yeah.
Yeah, we're a little late anyway.
Yeah, it's raining day, so.
Yeah, all right, and let me put the. Yeah, I'll take a few minutes anyway to get all this set up.
You know what I found?
What is that?
That's Trump.
Yeah, so she was just she was at SMBC?
Yeah, no, like we are having a like just like kind of like meeting there, me and Trump and Peter in SNTC with like HSBC. That's like
You had a client meeting?
what?
You had at SMBC?
No, I was working at like HSBC.
Okay.
Like intern, not
Okay,
person.
okay.
And then we have a meeting there, like it's like kind of like talking about like public program, like from that stuff, and then like that like suddenly realized that the SMBC, I didn't realize.
Yeah. That's the
What, they were in SMBC?
Yeah, she was I think this is a fixed floor.
Oh, I don't remember.
Sixth floor.
So where were they in SMBC?
So she was interning with HSBC.
Yeah, that's
And
all
they went.
April. There's an event in like SMBC. Me, Trump, and Peter went that event. And
Sixth floor, we sat in the cafeteria area, right? That's pretty
yeah, I
cool.
think that's the one with like Bank of China and like some other people.
Yeah, that's the floor we sit in, sixth floor.
Yeah.
So there's another event. SMBC is doing a hiring event next week or something.
Really?
Yeah.
What about?
Hiring people, introductions. I think
So you should tell them, declare, announce in the class if anybody's interested, then come.
Let me see.
Professor,
Yeah.
is that your office in the university? There's a place that you do runs.
Yeah, sixth
Yeah.
floor, yeah, that's my
Yeah.
office.
I think she was
That's
sitting
my
there, right?
Yeah,
She
that's
was sitting
wrong.
there.
Yeah, this is wrong. Yeah, this is wrong. She was
Yeah.
there.
Yeah, you were on the main reception area. We're on the same floor, yeah.
We're having event there.
Yeah.
In April.
I was there yesterday. I only go once a week, so
Uh,
only on Mondays.
I think there's some session which is for next week. They're doing.
he sent it to me.
There's one
Correct.
June campus recruiting
Good.
virtual event.
This is all set up. I do need to take this call. So. Go ahead.
I think there's this is what it is. There's a June campus recruiting events. Yeah, you need to see if you go to SMBC, there's a class posted. So I think you guys can. It's a virtual, so you guys can join it.
Okay. Perfect.
You can share with
Thanks.
the class. And for next year, but you guys are graduating this year, next year?
Oh, I graduated next year, May.
Next year, yeah. So
So I have
internship are opening now, but for next year internship, people who are graduating the year after,
Oh.
and it's mostly for bachelor students. As of now, they have like this year we had 145 students, mostly from bachelor program who come in and they do internship, and this year they will do, next year they will join. Either people who are graduating this December or next May, they are interning now and they will get offers for this year or next year.
But like for which groups?
All
Yes,
groups.
and
All groups, yes.
Oh, so all groups they can apply for it?
Yeah.
That's perfect.
Are we full house? Should we start or should we wait?
What?
Start, wait.
Fair enough.
It's fine.
Let's start, right? And the rest of the people
Fine.
can join in.
Stay with
Do you
you.
want to keep that open? Door, Punyam, from the back?
That spill was open the whole day, so I don't know why it's open.
Okay. So, if we minimize the bottom right. Okay. So, this is the fourth lecture. So, what we will do today, we will get into practical stuff of how people start pricing CCR. And so, in lecture 1 we covered basic what is CCR, 2 we covered about how do we measure counterparty credit risk, 3rd we talked about how we mitigate the exposure. This class will focus on how do you price counterparty credit risk in transactions. When you do a transaction with a client, how do you price this cost in those transactions, and then what are the capital implications when you do this kind of trading activity? There's a balance sheet implication. So they have, like, let's say if they have 100 billion of capital, so if they have 100 billion of balance sheet, they will allocate some capital to do this kind of, because every asset will need some kind of a balance sheet allocation, right? So we will talk about how do we price counterparty credit risk, what we charge, and what we can't charge, what kind of a capital you have to hold, and you have to generate return on that capital for the shareholders, right? So this will now start combining those commercial features, right? There are 8 things we will cover today. 1, we will talk about why residual risk remains despite netting and collateral. What that residual, once you do all the netting, apply all the collateral, you still have some exposure that is left, right? We will talk about why that is there, and then understand what is credit valuation adjustment, CVA, and then we will talk about what are the key drivers of the CVA. We will talk about wrongway risk, stress scenarios, what is expected loss versus unexpected loss, and why the bank hold capital against counterparty credit risk, and what is the relationship between CVA, stress testing, and capital. Just before we start, I think there are 3 lenses to look at counterparty credit risk, right? So there are 3 binoculars, how I say. The first binocular is you look at what is the price of counterparty credit risk that you have to charge the client. That's the one way of looking at CCR. Another binocular to look at CCR is the second line, which looks at what is my worst case exposure, what limit I need to sign off. So that is always within my risk appetite. That's the second binocular, right? And the third binocular is where you look at the capital, right? So it's like, so if you need to understand CCR, there are 3 lenses. Once you look through everything, and I'm mostly in the second lens, but I know what is going on in the first and second because I have the oversight. But each lens is specific. The first will come in, like, which will be a CVA desk. They will go in, what is the kind of expected loss? They will go and charge that client, right? That expected loss. Second, people will say, okay, you charged it, good enough, but over the life cycle, I need to know what credit limit I am giving, right? For example, a credit card company will say, always need to stay within $20,000 limit of your credit card expenses, right? And then third will say, more on the capital, like even if you are within that 20,000 limit, if you're trying to do trading activity, like you still need to pay for it from capital, or you have to generate certain return if you're doing that. So we'll talk about all the 3 lenses today, right? So let's go through a client in a bank setup. I think we covered a little bit in pieces in the first, second, and third lecture, but let's see what a classic setup will look like, right? So a client will come in, let's say a corporate client, and it's taking out a loan from a bank where this corporate client, which is an end user, it's paying a floating rate to the bank. Now, this end user wants a certainty on the payments. In this case, if you're taking a loan, if the floating rate changes every month based on whatever the rate is, like they don't have that certainty, right? So what they do is when they take a loan, if they have to pay a floating rate, what they want to do is they want to remove this uncertainty. They will enter this end user, which is a corporate client, will enter into a swap with a bank saying, oh, I have to pay a floating rate to the bank. Why don't you pay me the floating rate? I pay you the fixed rate. We will agree on that fixed rate over 10 years. This way, I will never have any uncertainty because I know whatever the floating rate will be, you will give me, I will pass it on, I will just pay you a fixed rate. This way, you are removing that uncertainty for this end user, which is not in a business of managing an interest rate risk, right? Because they are running a business and they want to make sure, like, I already know what my revenue is. I already want to know what my expenses are. I don't want those interest rate expenses go up and down. So so that I can always manage my bottom line, right? So this is how a end user, a corporate client will come to you. It will need money for its activities, whether it's a working capital, whether it's expansion, and from there on, when it takes a loan, it will enter into a hedge, which will convert that floating rate of loan to a fixed rate. So this is what you call as floating to fixed conversion. A client has come in to convert its floating obligations to fixed obligations, right? Now over here, so this bank will come in. So imagine this is a bank who is executing the swap with this corporate client. Now this bank also, like if he's paying the bank is paying the floating rate and getting the fixed rate. Now bank doesn't want to expose itself like into interest rate risk as well, because the bank is just intermediary between multiple. What it's making money is, if I'm charging 5.1 over here as interest, right? I'm paying, let's say 5.05 over here. If I'm making between the bid and ask. I'm not in a business as a bank to take interest rate risk, right? Because that will just kind of not. So after even 2008-9, banks are stopped to take any directional view on like any activities. They can't be a proprietary desk. They have to, if they are into, just think them as a broker. They're the broker. They don't get into any directional. They are just the broker in between, and what they're trying to do is they're just making money between bid and ask. Now, what happens in this whole case? Now, the corporate client, it hedged its uncertainty with this fixed rate. Bank has also hedged like its interest rate risk, because it has to pay floating. It's entering into a hedge with a bank, and that bank is paying its floating. It's whatever fixed rate it's getting from the client, it is passing some portion of that fixed rate to the hedge. But the difference over here is this whole transaction will be uncollateralized in one case, where this client is not posting any collateral to the bank, but when the bank will hedge it with, let's say SMBC will hedge with Bank of America, because each and every bank will have this kind of a hedge relationship where they're just trying to provide liquidity. All those relationships are collateralized because banks don't want to take risk. They will say, we two banks, like we will agree on like a collateralized, whatever mark to market is, we will just settle. This client, sometimes they don't want to get into collateralization because that introduces more operations on their side. They have to agree to margin call, post margin call, they have to raise the collateral, etc. So that is how a general setup looks like, right? So a client enters it takes a loan, it converts its floating rate obligations to fixed rate, and then the bank shelves that interest rate, like what it's paying floating, it will just enter into a collateralized hedge with another broker dealer, and that's how a classic setup will work, right? So just one example, right? Now, so let's say, so in the previous case, now we know that this end user has to pay a fixed rate to the bank, right? And that fixed rate we are talking about over here. Now, if you have two counterparties, let's say there's a counterparty, client A, which is an investment grade, very highly rated corporate, and there's a client B, which is a non-investment, a little distressed kind of energy company. Do you think for the same trade, so let's say they both are doing the same trade, so it's a 10-year interest rate swap where they are paying fixed and they're receiving float. It's the same risk, same trade. Do you think they should be paying the same fixed rate to the bank?
No.
Why?
Because of the risk involved in terms of their ratings. Say for example, you have client A, which is an investment grade, and then client B is a non-investment grade, which is somehow riskier. It's just about the risk between the two of them.
So the bank will charge.
The one with the higher risk,
They will charge the higher rate.
yeah.
Right?
higher
So
rate.
very similar to if you go into like any if you take a car
Yeah.
and you're saying somebody who has a very good credit rating will get a less rate versus somebody who has a bad rating will have to pay more. Right? So now, so that's the right answer. So so what the client pays, this depends on the rating, and we will get into that in a few seconds, that how you determine that price, who will pay what, right? But in this whole transaction, the bank has eliminated its market risk by entering into a hedge, right? But the bank is facing counterparty risk on both sides. One bank is facing to the client, and the bank is also facing to the other hedge provider. right? Because the market risk is hedged fully, but now you have one counterparty risk and over here counterparty risk. So again, in the risk space, you think it as water, right? Either sometimes it will become steam, sometimes it will become ice cube. Water never evaporates, so risk never gets eliminated. It just transfers form. So in this case, if the client wanted to take the uncertainty off and they went into the bank, and bank said, I don't want market risk, but I'm fine to take the counterparty carrier risk. So you're just transforming like the form of the risk you are taking, because you may be comfortable with managing that risk versus managing this high interest rate on the book. Right? Now, so what makes an investment grade counterparty to pay less versus a non-investment grade? This is what you call as credit valuation adjustment, CVA. Pretty important concept, and this is the first lens. If you're looking at the front office, when you price a transaction with a counterparty, this is the first lens where you look at how much I should charge the client for the risk which I am taking. So the CVA, credit valuation adjustment, is the market value of the expected future counterparty credit risk losses. Right? So what it is, so we will take this example. So let's say in a risk-free market, if the trade we are doing this one, the bank and so this trade, like if you just take all the counterparty considerations away, if you say I have floating cash flows over the next 10 years, let's say it's every 6 months you are making 20 payments, floating rate. You already know what those floating rate curve is looking like today. If you have to price what is the fixed rate today, you will take the future cash flows from both sides and equate, right? Because it has to be zero sum game, right? You will get a fixed rate today. So let's say that risk-free rate today is 5%, right? So that's like when you go into the market, there's a baseline, like what you say as a market published rate, risk-free rate. In this case, let's say that rate is 5%, right? Now, for a very highly rated company, which has a very negligible, I'm just going to take an example, which is like Sovereign, right? Like which has negligible default risk, this fixed rate will be 5%, kind of a thing, where there's no counterparty risk. But for a risky counterparty, what the bank will do, it will calculate what is the probability of default of this counterparty, risky counterparty, there's a probability of default. Then you will calculate what is my expected positive exposure. If you remember, we talked about when we looked at futures, like the different types of exposure. We talked about current exposure, we talked about expected positive exposure, we talked about expected exposure, we also talked about potential future exposure. So what they look at, in this case, they will look at the probability of default. They will also look at what is the expected positive exposure to this counterparty over the life cycle, and if the counterparty defaults, what's the loss given default. Now, if you multiply the three, the probability of default, so let's say we are saying this is the exposure that we are looking at, multiplied with the probability of default LGD, that will give you what is your expected loss to this counterparty. Now, this expected loss for every counterparty will be different, because their probability of default will be different, even though the EP will be the same, but your loss given default will be different, like how much you can recover if the counterparty goes default, what kind of assets they have, what can you liquidate, how many other people have claims on that. So this LGD is not constant, this PT is not, you don't know. So each counterparty will have a different expected loss, right? Now, let's say we calculate for this counterparty, for this risky counterparty, that number expected loss is 500K. So what do you do with this 500K is, this you need to charge the client. So you're not charging the client upfront, saying give me 500K. So when you go and buy, like take a mortgage, you have two ways of doing a mortgage, right? One, they say pay a higher rate, right? And anybody has taken mortgage? I think many, right? Anyone has a house mortgage? Yes. Right? So you have the ability to pay the points upfront, right? You can also, like if they're saying this is a market rate, like say 5% or 6%, they can also say if you pay me 500K today, right? Like all the points today, your rate will be less, right? So there are two ways. One, you could say, like you pay me upfront, so you have to pay less points, right? So this is expected loss you have to pay. If you have to pay this 5%, right? You have to pay for this expected loss, but that's not how the market works. The market will do is, when you price these transactions, you will say, you are not going to pay me 5%, but what I will do is I will take this average expected loss with you, which is 500K, I will convert that into a spread. So for a 10-year interest rate swap, let's say that 1 bip swap spread is 80k, you will say that I have to charge 6 bips more. It has to pay 6 bips more every year to me, so that it will make up that 500k. Now the CVA charge will be 6 bips. So you look at your expected loss, you divide it by the duration of that swap, and you come up with kind of what that spread will look like. That will amount to 500k, and that will become the fixed rate quote. So what you're going to do is you're going to say, the client, you pay me 5.06, I pay you floating. You have on the other side Bank of America, the bank. It's going to execute a swap with them at 5%. So it's making 6 bips in between. Right? So that's how the banks will make money and how they will charge for CVA. So this is this is the first thing. Any transaction you will get into a derivative, there will be, based on the counterparty rating and their probability of default and LGD, there will be a charge, CVA charge, that will get embedded, and that will become your rate, which they will be paying you in this case. Like this fixed rate will become that 5.06. Right? So I'm just taking, first of all, a very simple example of CVA. We will build on this, but I think this is important, that there is exposure to the average exposure to the trade. You calculate expected loss. You calculate what that CVA amount is, expected loss. Then you make this pricing adjustment and you make it 0.4. Right? Now, investment grade counterpart like Microsoft will pay 5.01, maybe because its expected loss is less. If you are a non-investment grade energy company, this may be 5.06. We just calculate this loss as 500k. If it's a non-investment hedge fund, then in that case, let's say this expected loss was 1 million. You will charge for that in this quote. Right? So they have to pay you 5.12. So you price that expected loss in the transaction upfront. Right? Now, if we deep dive into that whole CVA, PD multiplied by expected positive exposure multiplied by loss given default, PD will give you, will they default? What's the probability of them defaulting? Okay? EPE will give you, if they default, what is the average positive exposure? Who can tell me again the difference between expected exposure and expected positive exposure? You remember we talked about expected exposure? Expected positive exposure?
That's where you're expecting to get money out of that probability scenario versus the other ones. There's zero, like if there was a negative percentage of losing money, you're not going to count that for the positive exposure part.
So
I didn't say it well, but
yeah. So let me rephrase. So forget about the probability of default. Let's just talk about the swap. Right? We know that we will run simulations. Right? Let's say we run 2,000 simulations. In that case, if you will have different mark-to-markets in future, in expected exposure, you just take the average of all. You remember we divided by 5, whatever the outcomes were? In expected positive exposure, we still divide by 5, but we only took the positive exposures because that's the only money they owe you. I think that's what you're trying to refer to, right, Cliff? So this EPE is your average exposure, positive exposure. That's the how much money it will be owed to you. And then let's say they default. There's a money owed to you. How much can you recover?
That's what I was starting, right? I forgot. Did you see? Do I recall this?
You may have to go down.
You say stop the process.
Stop? Yeah, we may have to stop.
Crowd sharing. And then.
So it was funny today in office. I was speaking to like a couple of colleagues, and they were saying, and once they did the whole meeting, they said, "Oh, let's go through it again because I can take all the notes." I said we should have switched on the Copilot. It should have taken all the notes of the class, all the discussion, so that we don't have to repeat now. Oh, these are 20 things we are supposed to do. That's pretty amazing though. Copilot gives you exact summary of the lecture, and it does it even better.
Yeah, but sometimes it can't interpret things, especially if it's a fuzzy line, a fuzzy topic. But sorry about that. Now I recorded it.
Is this slide uploaded?
Slides I will upload. You just.
They're not
I'm
visible
sorry,
yet.
guys. I had a.
The slides aren't visible yet.
My apologies. I mean, I had a death in the family today, so yeah, I didn't do a lot of things, but I'm still on the phone with folks. So I'll upload everything after the class. Okay.
So, so this whole formula, you are looking at three key components. One is what's the probability of default? Like like will they default? If they default, how much it will be owed? Like on an average basis, average cost of exposure, and based on like this loss, how much I can recover. So you have LGD, loss given default, or you can also call this as 1 minus recovery rate. Same thing, right? So loss given default is 1 minus how much you can recover, right? So people use this like interchangeably. Sometimes they say 1 minus recovery. What's my recovery? That is 1 minus LGD, right? So these are the three components. So this is the first lens we were talking. When you get into a transaction, that is how a practitioner like actually desk, so will be sitting, he will be pricing how much I need to charge, because this is revenue. If you don't charge this money upfront, you're leaving the money on the table, right? Now let's understand this kind of this dynamics where we are trying to multiply the three PD, EPE, and LGD. Let's say there are two counterparties which have exactly the same credit quality. That means they have the same probability of default, they have the same loss given default, right? In one case, but the trades are two different trades where they both are 10-year, but one swap is creating an exposure of 5 million. Let's say this is a cross currency swap, and this is creating a 50 million exposure. Which do you think, like counterparty A or counterparty B will have a higher CVA charge? Who should be charged more? B.
Yeah, 10 times more.
Right? Because you have higher exposure, even though PD and LGD are the same, but the EP is higher, so the expected loss will be higher. You will be charging with this for the same counterparty, based on the different rates, you will be charging two different rates, right? Because of the expected loss. Now, let's say there are two counterparties which have the same PD and exactly same EPE, right? So let's say same rated counterparty and the trade is also the same. Let's say 10-year interest rate swap, right? Now, in one, if a counterparty default A, which has an LGD of 60%, because their assets are not that good enough, if you go and sell in the market, you're not gonna get the full money. You're gonna only recover 40%. Recovery is 40%. That means loss given default is 60%. For other counterparty, where loss given default is lower because they have a higher quality assets, which counterparty will generate larger CVA? A or B?
B.
Okay, because it has a higher loss given default, right? You have to. So again, the essence what I'm trying to come at is the expected loss. You can have counterparty with the same credit quality, right? But a different kind of a trade will generate a different charge. You can have the same PD, same EP, but the loss given default is separate. You may have to charge like a different rate to the two counterparties. And now, and we already talked about like another scenario with like different PD, because we talked about Microsoft, we talked about hedge fund. We already covered that. The ones which have different PD, you will be definitely charging more. If you were looking at over here, they have client A, B, C have a different PD because they are rated differently. Even though they are doing the same trade, let's say they have the same loss given default, but considering they have a different probability of default, you will charge them differently. Okay? Now, what happens? Like, so let's say for the same trade, same counterparty. So let's say Microsoft wants 10-year interest rate trade. They come to SMBC, they come to Bank of America. SMBC asks them for 300K, like the CV expected loss is 300K. Bank B is asking, like Bank of America, let's say, is asking for 600K. So they're asking for a higher spread. How both can be reasonable?
Because they're both looking at it from different directions.
Different direction. It's the same trade. So let's say
Yeah, but you're one's making the trade, the other's making the same trade backwards, the floating versus the fixed.
So let's forget that the hedge trade. Let's say if I go back. So let's say this client had two options. Either it comes to SMBC or it comes to Bank of America. Because the Bank
Okay,
of
I
America
see what
refused
you're
you.
saying, yeah.
But let's say it came to Citigroup.
So
Let me
it's
make
the
it
exact
simple.
same trade, just two different banks.
It comes to two different banks.
Okay.
One says that I will charge you lower because my CV estimate is 300K. Another is saying I will charge you 600K. How both can be reasonable?
the charge, I believe before they arrive at the CBA, they have done all their calculation in terms of determining the exposure. So in terms of reasonability, Bank A will be more reasonable.
So both from their own, so for the client, so this is how you get into competition. So you will get into who will give me the cheapest,
Cheapest, yeah.
right? But what I'm saying is Bank B wrong in estimating 600K? My question is a little different.
Okay.
So you go to Macy's or you go to JCPenney, both charge differently for the same shirt.
Well,
So I think that the fact the APA will be different because it depends on the view on how to calculate the APA or LGD. Yeah, maybe default is the same because they have same background of.
Even default can be different. Somebody is saying you are a double B, somebody is saying you are a triple B because you're doing internal grading. Right? So that's the right answer. So everyone will have a different model to calculate TPE. Right? Because they will run different Monte Carlo, different assumptions. Everyone will have a different view of their LGD. Everyone have a different view of PD. So both are reasonable. That's where you get into bidding war. Right? Because if you're going to mortgage, like me going to JP Morgan or going to Citibank, I'm the same risk. But they may be seeing me differently. One is quoting me one price for a 30-year fixed rate. Another one is charging me another rate. It's not that both are wrong. It's just like their view of me is different. What Fong said. Right? Yep,
Question.
yep.
So is it normal for like two banks, they actually like for their CPA, they have like that large amount difference, like it's almost like double from the bank A?
Yeah,
Is it normal?
yeah.
Okay.
That's how you get into bidding wars. So if JP Morgan quotes you, like you give me a 30-year fixed mortgage for 5%, and Citibank, like JP Morgan is saying 5%, Citibank is saying 6%. You have seen those scenarios in the market. If you go for mortgage, they will have a totally different rates.
Can like a LGD is increased if let's say Bank A has a not just relationship as a contract with Bank B, but not only that transaction but another transaction. So like multiple transactions with the same bank, is it increasing the LGD?
It will not increase the LGD because what is your loss given default is you are looking at the counterparty and saying what assets you have. I need to liquidate those. If you don't pay me on this swap, I need to liquidate those. Right? And we will get into that. That's a good question. Like how you can manage these LGDs. If I'm like, let's say one bank will say, I need a seniority protection. I have the first lien on you. Then your LGD will be lower because I have the first lien. Somebody who has a second or third lien will have a higher LGD. So that is how, like we will get into that, how banks manage around it based on the documentation they have, how strict that documentation is. But you can always say, you know what, I have the first lien, I need to get paid first. My seniority is higher. If you are negotiating those, that's how you can bring these costs down. But that's a good question. Like I think that's how they look at LGD more from, and we will get into each component in a few minutes. I think, but what essentially is important to understand is the price you are charging the client can be different. One based on the probability of default. One, if these are different rates, you will charge differently. If the last given default is different, you will charge differently. But if, like, even if the same counterparty, same trade, these can be also different because this depends on the view from the bank, like what they think the EPE will be, what they think the probability of default will be, what they think the LGD will be, what kind of protections they have. Okay. Now, let's say like you do this 10-year swap, 10 year passes, no counterparty default happens, right? Do you think the charge the company made, the CBA charge, they asked them to pay more, right, and include, was that wrong? When you charge upfront, you were charging for a loss, but that loss never happened. Do you think this is wrong?
No.
Why?
It's part of business.
I mean, but at the time of charging, I mean, it was justified. So.
Yes.
doesn't
Right. So
matter if they-
you're charging for the expected loss.
Right.
Whether that loss happens, that outcome happens or not, right? But you are charging for expected loss. You are not even charging for extreme loss, right? because you can say, oh, I look at my not EPE, I will look at my potential future exposure, which is 97.5 percentile, worst case. We're not looking at that. You're charging an average. That was the view when you started the relationship. You did not know after 10 years whether the counterparty will default or not, but you still need to charge the CVA. Right? So this is the first. So whenever you get into transaction, this is what you look at, like pricing a transaction. Right? Now, so we will talk about all the three building blocks. Right? So the first building block is this probability of default. Right? So this probability of default measures the likelihood that a counterparty will fail to meet its obligation over a specified time horizon. Right? Now, how does a bank estimates this PD? There are multiple ways how you can estimate, right? So you can go into markets and say, what is my CDS spread? Right? You will say, what is my CDS spread of this counterparty? That's so generally what they do. So generally what is required to be done, it has to be market implied. Because what are you charging upfront? Think of it this way: if you charge someone 500K through this basis point, you are required to hedge it. You're charging. So somebody who's charging, so this desk that charges, that's called XV desk, CV or XV desk, right? What they do is, they will say, now you charge the client, transfer this 500K to me, and this is where I will create a pool from all the counterparties, and as a desk, I will select which one I like the credit, which one I want to hedge, which one I don't want to hedge. They still need to operate under market risk, like they cannot take too much directional risk on credit. They cannot take too much risk on like interest rate moves, but they still manage. They get a pool of these premiums they charge. It comes into a common pot, and they are required to manage it. So the expectation is that over time you are hedging it actively. If you see a counterparty is deteriorating, go buy a CDS hedge. Okay? So that is, but what they do is when they charge at that time, they look at what is the probability of default. They cannot just look at the PD which comes internally. They have to use a market implied measure. The reason is they have to go and hedge in the market. So you are pricing something that you have to hedge. If you have to hedge in the market, you have to use what market is telling you, not what you think. Right? You will go into the market and say, you know what is the CDS spread on Microsoft? Right? So that's one way. You can have the CDS, but not all counterparties in the market will have CDS, active liquid CDS on their names. Right? Verizon may have it, Microsoft may have it, but if you are going with some other counterparty which is not that public, they may not have a single name CDS hedge. Right? What you look at then is what is the bond spread on them. So if they have issued bonds on the risk-free, what is the premium they are paying? That's also kind of a proxy, because they are paying more because people have borrowed. They have borrowed money from the people and they're compensating using that bond spread to the people. So you will get to know how market perceives their credit riskiness. Right? So you will either look at the CDS spread if that is available. You will look at bond spreads, or you will also, sometimes you also benchmark it. What is the rating? Does it sound reasonable? If you're looking at investment grade, you're saying, like, you know what, it will be between 80 bips to 150 bips. If it's a non-investment grade, you're saying this will go to the north of maybe 200 bips, 300 bips, 400 bips, based on how, where it ranks in the non-investment grade. But that is how you look at, like, from market, what is the market implied measure of this probability of default, how market is perceiving this probability of default. Then, so why they're using, I think we just answered, right? So because what happens with, so one, you have to price, and as things move, the credit spreads will move pretty quickly. So if I say, if I don't use market implied a credit spread, if I use something else, the most efficient thing is the market. Because it will tell you if there is a new information in the market that this counterparty is risky, it will very quickly translate. The credit spread will change pretty quickly. Maybe the downgrade will happen like in like maybe in 1 month, 2 months, 3 months. That may take time, but you're not gonna wait for that. If you have to hedge, you need to see like what is the most efficient transmission as the new information on the counterparty comes in. The credit spreads will either widen or tighten. If it's a bad news, the credit spreads will start widening up. If it's a good news, it may start tightening up. Right? People may see them as less risky versus if there's a negative news, and that what drives the PD, probability of default. And we will get into Like when you look at a CDS spread in the market, let's say for a given counterparty, let's say Microsoft, I'm gonna make it up, it has 120 bips of credit spread. If you go into the market, that's what market is saying. This is what you should be charging as a credit spread. But how you calculate this PD? This 120 bips assumes the loss given default is 60%. There's some standard conventions in the market, because that way only you can derive what is the probability of default. So if 120 bips, 60% LGD, you divide 120 bips with 60, that's a 2% probability of default. If this was 240, this probability of default was 4%. If it was 480, this probability of default was 8%. So that is how you look at, you say what is my CDS spread? I will divide it by 0.6. That will give me the probability of default for that counterparty. That is what gets into this calculation. So you look at the credit spreads, you derive this PD, and that PD goes into the calculation of CD. Questions? So, but what is one of the biggest? So we talked about like not every counterparty will have a liquid CDS spread or a bond spread. So if you don't have CDS, we talk about bond spread. But let's say you don't even have, so it's a private company that doesn't even have a bond issued in the market. What will you do? It's a private company, right? No bonds. They did not ever raise money through bond issuance. Then you will start looking at proxy CDS. What you will do is, what is the rating of this counterparty? If external rating is available, that's fine. Maybe they have a rating but they never issued a bond. Or it could be, if there is no rating externally available, you will look at your credit team to rate this counterparty based on the financials. And every firm on the street, they have to have an internal grade. They can benchmark it against Moody, S&P, but they are required to have their internal grade, right? Generally, CBA will not use, the CBA desk, this PD will not use this. It will only use it if this is not available. So they will look at, hey, what is the rating of this counterparty, what is the sector it's operating, what's the country, what other parameters, then they will say, let me derive a proxy CDS. So that is where, like, if we have a book of, let's say, 5,000 counterparties, only 500 will have a CDS, even less. Maybe another 200 or 300 will have bonds issuance, but rest goes through proxy. You're trying to estimate that proxy. There's oversight. You don't want them to be aggressive, because if they will be too aggressive and they're charging less for the expected loss. If they're charging too much high, they will lose the deal, because somebody else in the market will price it better. Just think it as like there are two gas stations in front of each other. One that is charging less for the gas, one that is charging higher. You will lose the deals if you're charging too much. So that's how the efficient markets will work. You will always constantly benchmark, saying why we lost the deal, are we being too conservative, too aggressive, etc. The second building block is the expected positive exposure. Right? So we talked about two different traits. One with a expected EPE of 5 million versus 50 million will have a very different CVA charge. So the reason why CVA uses EPE, because they're charging you for the expected loss. They're not charging you for the tail risk. The PFE, so you had three measures. Expected exposure EE, we had EPE, and we had PFE. PFE gives you the worst case risk with 97.5 confidence interval, percentile confidence interval. EPE was average positive exposure. EE was like considering every positive negative. That's not the right what they owe you. So the way to represent this is more, the CVA will generally charge for expected loss. The PFE is primarily used, and we will talk about that in limit setting. We talked about the second lens, that when you look at your worst case exposure, or you look at your stress testing, you look at your capital. But essentially, your EP is the one what CVA uses. But now, the bank has a way to bring. So let's say, and this is what we learned in the last class. If you remember, we talked about mitigants. So let's say if there was no netting, no collateral, this EPE was 50 million. Same PD, same LGD. The CVA was 1.5 million. Okay? If you have a closeout netting, this EP will go down to 30, because you can net the position positive, negative. This charge will come down. You will charge less the client. Okay? if there's a daily variation margin, this will even come down because you're now margining it on a daily basis. This charge will be lesser. If you have initial margin, if you remember last time we discussed, for a daily margin, you still have exposure till the threshold, but if you have initial margin, that even brings your threshold lower because you are having more security deposit. So that's even bringing it down. Let's say if you have a zero threshold CSA and IM, no threshold and IM, the CP will go less, so you're gonna even charge less. So that is one thing that banks primarily use when they look at if the charge has to be less, they will say, what will make my EPE lower? They will actively work on bringing the CPE down if they want to be competitive in the market. Right? And that will depend on what kind of a legal document you will negotiate with the counterparty, what kind of a CSA you will negotiate. But if you negotiate the right CSAs, you will be able to bring this cost down. The third building block is a loss given default. Right? So if default occurs, how much do we actually lose? So this loss given default measures that percentage of exposure that is expected to be lost if a counterparty defaults. So lower the LGD, lower the charge. So this is where Peter will come into here, what brings this LGD down. Right? So if you have a seniority of claims, like who gets paid first in bankruptcy, a secured lender or unsecured creditor. More senior claim, more recovery. That means higher seniority, lower LGD. If the counterparty, if let's say you have the same seniority of the claim, but the quality of the asset is higher, the LGD will be lower. Better assets, lower LGD, because in this case, like let's say there are two counterparties, one is a utility company, one is a distressed technology startup. This utility company will have more tangible assets. They will have a power plant, they will have like more assets like offices, you can liquidate those, versus what a distressed technology startup had, they literally have no stable cash flows. So in those cases, the recovery will be even lower. So you will have a lower, like you have a higher LGD for a distressed startup, and that will affect your cost. What do you have to pay? If you're a software company, a distress, you may have to pay higher. Versus if you're a utility company, you have lower LGD, you may be able to get a better rate because you can say I have a collateral that you can liquidate, so you have to give me better pricing. Economic environment. So if you are in a normal market scenario, you may have a lower LGD, but if you get into financial crisis, let's say the same counterparty, like let's say Microsoft, their LGD in a normal scenario may be higher, may be lower, but if you get into a dot-com burst, a financial crisis, you may have a higher LGD. So this also decides like which economic environment you are. In that economic environment, maybe when we did this trade, you were in a better economy, you charged less. But as the crisis happened, your LGD will drive up. So whatever you charge may not be enough. So when you charge these things, you need to constantly look at market. Like, and I will give you an example where you charge, let's say, 500K to a given counterparty upfront, but every day, on day zero, when you did this trade, the P&L for the XP desk will be zero. Because you price the same day, you know what PD, LGD, and EPE was. Now if markets move, probability of default moves, credit spreads move, and like LGD moves because of the credit situation, that desk will start seeing the P&L. Whether if it's in a bad market, they will say I have a negative P&L because I never hedged it in the market. So that's what forces them hedging. What you don't want is you just take the premium, you never hedge it. Now people start dying, you start have to pay for all the life insurances because you never hedged it. Right? And the last is legal and bankruptcy framework. So if a company is based out of US, you know there's a very well-established bankruptcy process. Versus if the company is out of Brazil, you know that it has a weak jurisdiction. So in US you will have a stronger credit protections. When I go for bankruptcy and say you need to pay me, in US I will be able to recover more versus Brazil. Right? So a stronger legal framework of a country or jurisdiction, you will have a lower LGD. So these were three. So one, you charge this upfront. So based on this, what your view is at the start of the transaction, it can constantly change over the life cycle of the transaction, and you are expected, like as a CBA desk, you are expected to hedge it. So in the second line, I will also have the oversight on the first line. Are they pricing it right? Are they hedging it right? Right. So recently we were in over the last 3 or 4 days, I was for a big counterparty we had. I was constantly butting my heads with the CVA desk. I said, guys, you need to start hedging. They were said, oh no, we are fine with exposure. I said, no, we are not comfortable as credit. We need to start hedging. So they went in, they bought $200 million of CDS on that counterparty. That's why you say like sometimes they can be relaxed, because for them, why we have to spend the money if we are fine? But you can force their hand if you are not comfortable as second line. Right? Or even I can force the hand, and we will talk about third lens, the capital lens, which can also force the hand of XV desk. No, you cannot just keep on sitting on this exposure. You charged it upfront. You chose not to hedge. I'm not comfortable. You need to now go start hedging it. And then sometimes they come, oh, now it's too pricey for me to hedge it. No, because you never did the hedge earlier. Now you have to pay up the price. So, are we clear how we charge the expected loss? Any questions? CVA, how CVA is calculated?
During the contract, the charge cannot be increased for the client, right? Just to make sure, okay.
Yes, and you can't increase, but if let's say over time they do new trades, like let's say they did 5 trades upfront, then they come after 2 years and do more trades. That time PD, LGD and EP may be a different view. For that trade, you can charge differently, but not for the trade you already charged. So it's like if you buy a life insurance for next 10 years, you agree on a premium now. Now the company cannot come and say, now pay me more because I think we found you have some pre-existing disease. And that's why sometimes people take those life insurances little younger. When they don't have issues, they have to pay less premium. Versus you go when really you are in a bad health, the insurance company will charge you more. But if you bought it earlier, you're agreeing for the next 20 years, I will pay you this premium. Now, if something happens, they won't come and ask you to, now you need to pay me more insurance. No, that's not how it works. Does that answer your question, Peter?
Yes, yes.
Any other questions? Okay. So we talked about CVA, but there's I started with CVA, but we said that there's more to it. Right? That is not the only cost you charge a client. Right? So again, coming back, in the fixed rate, like you are not just, the bank is not just being compensated for the expected loss only. You also need to see how much capital I need to keep on the side to do this trading activity. And I will get into that, how you calculate those capital. But just for the sake of simplicity, let's say there's a cost of holding the capital against this transaction, which is that cost to me as a company is 500K. This expected loss was 500K. Then if I'm doing this trade with this client where they are not posting me any collateral, I do still have to hedge. If I have to hedge, so let's say they owe me money, but they are not posting me collateral, but if I am hedging, so in this case, if you look at this transaction which was uncollateralized, let's say in this case, you are at a point where the client owes you money, right? And you are into this derivative hedge. If they owe you money, you owe to the hedge, because so you are being paid fixed, you are paying them floating. Now, if on this transaction they owe you money, that means on the hedge you owe the money because you are being a pass-through, right? Because you are taking the opposite position. If somebody owes you money and you have taken the opposite position, then you owe that money to somebody, right? Now, if somebody negotiated an uncollateralized contract, you still have, if you are in the interbank market between SMBC and let's say Bank of America, you still have this collateralized transaction. You have to, even they don't pay you collateral, you have to pay for this collateral, right? So you have to fund that collateral. There's a cost of funding this uncollateralized exposure on this side. You have to charge for that because you still need to post that capital, which is the collateral over here. You have to fund that. So there's a cost to it. You calculate all these costs. Say for the expected loss, that cost was 500K. For this funding over the life cycle, this cost is 100K. for holding the capital that cost us 500K. The target profit you also need to return because you're not just doing pro bono, right? So you need to make money for the shareholders. Let's say that there is, if you're putting everything of this, you're saying I need to generate 200K for the capital I'm holding. Now, if you start adding this up, this will become total cost of 1.25 million on this trade. You have to charge 15.5 bips to the client.
To the client.
Okay. So even though on the other side you're entering into trade which is 5%, but over here you have to charge them 5.15%
It's
because
not
of all these costs.
Because it's not collateralized.
So if it's collateralized, what's going to happen? If it's collateralized, you see this will come down. If this will come down, even your funding will come down because this will go here. So this is collateralized, these costs will keep on going down.
So the question I wanted to ask is, say you as a client, you have gone to the bank, you want to, swap from the fixed, say from the floating to the fixed, okay? But you are not collateralizing the particular transaction itself. So you are saying now that in the event this bank A wants to pass it on to another bank, they want to collateralize our.
They have to be.
Okay.
By regulation, they have to.
So in this case, they will have to charge the client because they are providing collateral to like bank B.
Yes.
Okay.
Right? So this is more like when you lease, sometimes you have to pay higher for the lease, right? Because maybe you are fine paying that versus managing this collateral. Because this private company can say, you know what, we are not in the business of managing collateral. Even I have to go and source that collateral, source that liquidity. I'm better paying off this fee. For me, this is just an expense. It's like a lease, where you're saying I'm fine paying lease per month basis, versus if I have to put more capital, etc. I don't want to pay that. It's better for me to pay this cost because it's an expense. I can manage it through my workflow capital, working capital, and I can pay this. But I don't want cost upfront, or I don't want to manage this collateral because that's not the cost. I have to manage a team who will post collateral, receive collateral. That's the cost to me. I don't want that headache. But what it does, if you have on both sides you have collateralization, what happens is these costs start coming down significantly. Right? But for uncollateralized, you're gonna pay. So, and again, this is like 5.15, but then you look at maybe some other bank is charging 5.2, some other bank is charging 5.3 based on their view of their capital. If somebody has cheaper source of capital, that's a Japanese bank, the biggest advantage they had, the rates were in Japan was 0. So their cost of capital was very less. They can compete more versus an American bank where rates are higher. So this all comes into play. Right? So when you go for a client rate, you look at the market rate, which was 5%. You added a 6 bips for the expected loss. You added for the funding 1 bips. You added 6 bips, and again you added your profit margin 2.5 bips. That's how you come up with the client run trade in a real world. So I started with an example where we just looked at the market rate and CVA, but there are more costs of doing this business, and you have to charge a client. It's very similar like if you're going to a restaurant, you just don't pay for just the food that the cost of the food, right? You don't just pay for the cost of the food. Like you say, oh, if I go to Whole Foods, the cost of the food was lower, why I should pay you higher? There's more of cost of running that business. You have to pay to the waiter. You have to you will have some like some of your raw material will go bad, right? So that is what I call as your expected loss. If you know that there will be some grocery that will go bad, right? On an average, if the people who come for fish, right? Some of my fish will go bad. I need to charge for that expected loss, like in the rate of that kind of dish that I'm charging them.
Okay, as a banker, considering this scenario now, what has been the experience for a client that is not providing a collateral
So
and being charged these high amounts,
yeah, some people say a lot of big corporates, they're fine paying higher. They don't want to just.
So that the final outcome, is it normally smooth, or there is always a probability of,
Because so these large corporates are going to 10 banks, right? So if you're going to 10 banks, right, everyone is quoting you the same. You have to be confident
Okay.
because you at the end of the day you need this one, right? You're going to 10 people, like you need a mortgage,
Yes.
right? You say, oh, all banks are charging me higher for the mortgage, but you have to pay because you need a mortgage. So that was a good question.
Yeah, interesting.
Right? So this is dynamic. So I think a lot of times like we talk about, so the way I learned CVA, like what is a CVA? I learned all these definitions of, hey, this is the credit valuation adjustment, you calculate this. But this is the real how you come and start charging the client. That translates exactly what that cost means. How you charge it. When you quote, what do you charge it? It's not like a academic, like, hey, this is the calculation, you want this calculation to be perfect. At the end of the day, you're competing against the market. You have to calibrate yourself. You don't want to be Einstein and say, oh, this should be 30 bits because I have my model that can give me very accurate EPE, that can give me very accurate LGD, that can give me very accurate PD, but this cost is 30. You're gonna lose the deal. So you have to benchmark. It's very similar to if you go into the market and you want to buy a company, right? You can do all those analysis, DCF, like discounted cash flow. Have you heard discounted cash flows, right? So you can do those fundamental, but at the end of the day, you also come to the PE multiple. What's the trading PE multiple for this counterparty? You will come from 2 or 3 angles. You will come bottoms up. You will look at the peers. You will also look at the comparable transactions that went in the market. That is how you will say what is the fair value, fair price of this. Right? So even how much good models you can build, but if that's giving you cost higher, your desk will not get the money and the bank will not exist. They can't kind of do this business. Any other questions? Is it making sense? Okay. So we very quickly talked about the XVA, right? So if you look at the role of XVA and the CVA charge. So what is XVA? Basically there's more to that. It's stuck. 1 minute. And there's some lag. So let me explain why we call it XVA first. So when you have CVA, that's the C. You have funding, you have capital, K is for capital, right? There are even more. There's the margin valuation cost as well, right? There are more costs, but I'm just going to keep it simple. What mostly the banks use, they use credit valuation, they use funding valuation, and they use capital. What goes into account? There's also a DVA. That's called debt valuation adjustment. So where when you are pricing a counterparty, and I will just give you a flavor because once you read the book, you will see these terms: CVA, DVA, FVA, KVA, MVA, but that all like they are different forms of cost, and that's what's called XVA. But how you look at the counterparty and say there's an expected loss, the counterparty can also look at you and say, oh, I also have risk to you that you can also fail, right? So if you're looking from the counterparty side, they also have risk to you that you can fail. They also have expected exposure to you, right? They can also say you have LGD too. There's a DVA, but you will charge the counterparty CVA. But when you go into accounting for your P&L, you will also take DVA into account. Your own, again, that's controversial. Where people say why you are going to take benefit. So you are charging CVA, right, to a counterparty, but you're offsetting this for your P&L with DVA. And when you show you're trying to take a benefit of your own default onto these transactions for P&L benefit. Right? So there's more, but the essence of this, what I wanted to explain over here is XVA is kind of different kind of valuation adjustments that you have to do. And can someone tell me why it's called valuation adjustment? Why it's called valuation adjustment? We talked about price of counterparty risk. Right? We said CVA is the price of counterparty risk, market value of the expected counterparty losses. Why it's called valuation adjustment? Why it's called CVA? Like we understand, oh, you're pricing counterparty risk, right, into the transaction. But why it's called valuation adjustment? Any idea?
I guess the adjustment is for the, I mean, the free rate, but we, like the swap rate at 5%, but we need adjustment on that, we cannot just check 5%. So this is the adjustment, and the valuation is only the thing we do, come up with the adjustment.
That's a good answer, but that's answering the expect. You are taking the market value of the expected future losses. You are pricing in the deal. That's still a price. You are taking that valuation adjustment and you are adding it to the price. But why it's called valuation adjustment?
You're adjusting the rate at which you're gonna charge somebody.
It's not valuation, it's price. When you look at your balance sheet, you have an asset, right? So you have assets, you have liability, and you have equity, right? Asset is equal to liability plus equity. Now, if I have an asset on this transaction where counterparty owes me money, let's say it's a $100 million asset to me at any given time, right? Now, is that the full value of the asset I can show on my balance sheet? Or should I keep a reserve which is equivalent to the expected loss, which is the adjustment that I need to do to my asset? So if I'm saying I have asset plus liability, asset is equal to liability plus equity. You're bringing your assets down because you don't want to overestimate your assets. Because if you have more, so let's say asset is equal to liability plus equity. If you're marking your assets up, you're trying to mark your equity up.
Is it that you assume your asset is so what you expect you will get, that's kind of a risk-free?
Yes. And you make this valuation adjustment to make it
not risky.
not risky. Right? Because what you're saying is now my asset is not 100 million. Let's say this cost is 500K. My actual asset is 500K. Otherwise, you are trying to pump up your equity. Because asset is equal to liability plus equity. If assets are higher versus what their real value is, you cannot just show this 100 million is risk free. You have to make this adjustment on the balance sheet. Where on the balance sheet you will say, this is my asset, but I will keep a reserve against my asset, which is 500K. So net this asset, net value of this asset will be 100K minus whatever that value is. Like let's say that was 1 million, that asset. Now 500K, my net value of the asset is 1 million. Yeah, if the loss does not happen, this can translate into equity, what you made. Does it make sense? Why it's valuation adjustment? Because you are adjusting the value of the asset.
Oh, so Professor, is this similar to evaluating an asset like from FIFO to LIFO, like first in first out to last in first out? Is this similar to that?
That's different. This is where you're trying to say, like, when you mark your assets. So what happened in, so let me, why stock markets crash? When you say my share has gone down, what it means? Has your liability increased? No. What has gone down is assets. Because assets is equal to liability plus equity. If there's a bad news in the market that they gave bad loans, then what that means is you have to mark down your assets. That's gonna drive your share price down. Have you seen like when 2008 happened? A lot of people who gave mortgages, why the bank suffered? Because they were holding a lot of those mortgages as assets. And they were saying these are assets are very healthy. They were not taking, So that's why they say that you have to take a write-off. The write-off will be even on top of this adjustment.
So, am I correct to say, yeah, the credit valuation adjustments can also be considered in the balance sheet, like trying to value an asset on a fair value basis?
So CVA is fair value.
Okay.
This is accounting term. CVA reserve you have to keep on the balance sheet at a fair value. That's why you were using market implied measures.
Okay.
That's a very good linkage. So a lot of like in our bank, the chief accounting officer, he will look at what is my CVA balance. How accurate the CVA balance is. Is somebody trying to fudge up the CVA lower to just like showing less? Is it fair value or not? Because you have to say, what is my exit price on this relationship, on this trades? Because what front office will do? Like let's think about it. Right? Somebody in the front office, marketer, did a trade. They charged, let's say 5.06, right? And let's say they charge 6 bips. Their interest rate will be like, let's just pocket it. Counterparty default will never happen. Let's pocket the 6 bips. Let's pocket this 500K extra because we made this money, right? So this may not be a better example if I take this 5.15, right? You know you were supposed to take 2.5 bips, but if you also try to eat up the 6 bips into profits, and you are not keeping a reserve on the side, so what happens is this comes out of here and gets sent to a CVA desk, and they are given a pot to manage. And they are told you are not a profit-making desk, you are a utility desk. You need to make sure that you charge the counterparty for expected losses. You are hedging those losses. So this is what they will care. They will say, okay, so the chief accounting officer will look at. I need to look at my asset, my liabilities, and balance sheet, and my equity. I need to make sure my assets, liabilities are fair value. That's why, like all 2008, what happens is sometimes if people are underestimating these losses, so what will happen? Like let's say, and we will get into that. I'm not gonna pre-run, but we will see that pretty quickly. But the essential thing is you need to make sure you are not just popping up your equity by just being optimistic that these losses will not happen. Because if you're not keeping the reserve, that's why people ask you to keep these reserves on site. This is a valuation adjustment.
Okay, but you're not popping up the balance sheet because based on your explanation, this CVA has to be paid by the client.
It's paid by the client, but now this becomes your asset.
Yes, it's my asset. So that is the reason why I said it's valued on a fair value basis.
Yeah.
You have accounted for it already in anticipation that as the time passes by, the client pays those costs.
So let me rephrase. So let's say when you have a portfolio of this swap, let's say there's only one swap,
Yeah.
right? You have a mark to market at that time. What EP is 100 million.
Yes.
Now you show this is my asset on that trade. Right? Now you have 100 million as your asset. You have liability, you have equity.
Yes.
But is this really 100 million, or you have to take this cost off because there's expected loss on this asset? So if you have a house which you think there's no defect, and you're saying it's worth 1 million, but I know there's some defects. There's expected loss, a cost of like repairing a ceiling.
Yes.
Should you keep that on the side? That's the valuation adjustment. What you're keeping on the side, knowing this is not exactly worth, this house is not exactly worth 1 million. There's some cost I need to keep separate, which like I know will be the expected loss on this house. So that's why you're saying you will not keep, this house will not be 1 million, you will say this will be 1 million minus 50,000. Because that's what you're trying to overestimate. So that's what comes to fair value. Even if you're charging the client, fine. But what you're charging the client is, but then you say this is my profit, this is my full asset, and not keeping a reserve for the expected losses, then that will not be fair value. The fair value of the asset will be what is the asset, what is still the expected loss on this asset, the net is my fair value of the asset. That should go into the balance sheet. Make sense?
Yeah.
Okay, so this whole CVA, when you price, this also has balance sheet implications. So product control in a firm, like so, how CVA will interact. CVA will work with the marketer to say what price I want to charge. then product control accounting team will keep a hawk eye on this. They are not underestimating the losses, not trying to pop up and take the money out without hedging. From me, second line, I will try to keep an eye out. Are they hedging this risk enough? Or they just keep on sitting on this, which right now may be 6 bips, but if they keep on this and I say the counterparty will deteriorate, the 6 bips can become 50 bips. That's the risk to the bank. So XVA is being seen by the marketer who are looking for attractive pricing and releasing this 6 bips. Accounting is saying, I need to make sure as the market changes, you are reflecting this correct loss. And I will look at from second line, I will say, guys, you're sitting on 6 bips, it can become 50. I want you to start hedging. You cannot just keep on sitting on it. They're being pulled from all the 3 directions. Right? So that's a responsibility of XVA desk, right? So the modern XVA desk will not just simply calculate these adjustments, like what goes into the price or what you need to keep reserved. They need to actively manage, hedge and optimize counterparty credit risk, funding cost, margin cost, capital consumption. So what they will do as one, they will quantify the expected loss for the pricing upfront. They will assess what is the cost, funding, capital implications. They will incorporate all these XVA costs into transaction pricing. That's number one. We talked about that example. Then they will also, once the trade is done, they have to manage and hedge that CVA so that those reserves don't blow up, because that will be their P&L. They have to pay for it. Right? So they will reduce the P&L volatility arising from CVA movements that can be even the EPE, PD, LGDs. They will try to manage. Then, so as the markets will evolve, counterparty credit spreads will change. That means PD will change. Exposure profile will change. EP will change, because that EP is Monte Carlo from the day of transaction. If market move, that EP will be different over time. You need to make sure that exposure profile changes. You also, the whole CVA value will change. So they will get into buying CDS hedges. They will also try to hedge their interest rate risk, right? So they have to manage it on a daily basis. So they run sensitivities on a daily basis on the portfolio. Like, hey, we need to start managing our sensitivity. Then they also have to manage the capital consumption as well. If they're not hedging and the cost of holding capital is too high, they need to go and buy a hedge so that the capital cost can come down. But the success criteria for XVA desk will be how you can lower your CVA, how lower capital consumption you can have, lower stress exposure and high return on the capital. So this is a success criteria. So any XVA desk, if they don't lower their CVA, they keep on sitting, they have a large P&L because they chose not to do anything, that's a bad thing. If they did not bring the capital consumption down, it will not be good profit for the bank, because if the bank has to deploy the capital, they want to deploy at like where they will get the maximum profitability. So if they don't lower the capital consumption, they are not doing that in the best interest of the bank. In a stress scenario, if the losses really blow up, if they don't dynamically hedge over time, they just keep on sitting and one day they wake up and say, oh, let's hedge it down. Like, that's not a good strategy. They need to dynamically hedge so that they can lower the stress exposure. Right? And then that will mean you will have higher return on the capital. These are the success criteria of XVA desk. So XVA is a first line. What's the time? Do you want to take a break? 10 minutes? And we will then start with, from CVA we will transition to 2 more topics, long-way risk and stress testing and capital. in time.
Just in time.
We are just having an interval.
You have what?
We are having an interval.
Interval?
Yeah.
Oh, so excited about
The
this.
half movie is done. Where are you coming from? Interview?
No, there's like an award that I got. So it's like up in Housatonic College. Yeah, but it's like networking. So it's like an upskill basically. So if you're like looking for a job or you're a college student, which are like spread out in university, they do like for free. It's a Connecticut program. They do for free like Python courses, SQL, AWS. So what else?
It's an upskill. So it's a college that gives you upskill.
It's a Connecticut program that lets you upskill. So let's say you're a student and you want like, or you're somebody who's looking to change in career, or you're unemployed. They kind of get you in, and they have like networks. So the previous job that I got it through them.
Wow.
So and they came in, and I was like, I knew some people that, oh dude, I'll send you the jobs that we gotta like refer to, and it's like sponsored by TD Bank.
Sorry.
I know it's like McDonald's of banking, of restaurant.
Nothing for now, eh?
Huh?
No, I'm talking to Mateo.
Mateo. No, he's talking to
Mateo.
Mateo.
Oh, Mateo, yeah.
Nothing for now.
And what's the one in Bridgeport? MAT Bank.
MNT.
Yeah. It used to be People's Bank, and they kind of bought it out to get into this region. I used to work for People's a long time ago.
Was it?
Yeah, long time ago.
When did you leave army?
I'm still in this
Reserve.
as a guardsman in New York, actually.
You are reserve.
Yeah. So I'm an instructor now. So
Oh,
I'm
you're
like
an instructor.
I'm towards the end of my career. So I'm like, I don't want to deploy anymore. I
When
don't
were you
do-
last? When were you last deployed?
Kosovo. That was like it's a peacekeeping operation. That was like 5 years ago.
Costa Rica?
Huh?
Where did,
Kosovo.
Kosovo.
where's that?
Kosovo is
Oh,
in
you
Eastern
don't
Europe.
know something. Oh.
Serbia,
Yeah. Hold
Eastern
on.
Europe.
No.
How you say? See?
I'm gonna enjoy this.
I like
Maybe I'm not getting the pronunciation. How you spell it?
Kosovo. And you just literally write it's with a K.
Kosovo.
Yeah. But don't look it up.
Kosovo.
Everything knows Google. No, I'll tell you.
Kosovo, okay.
Have you heard of Yugoslavia?
Yugoslavia.
Yeah.
So it collapsed, and there was a civil war. People were killing each other because it used to be multi-ethnic country.
Yeah,
and
it's
Broz
Muslim.
Tito used to
Broz,
kind
yeah.
of hold. He's like kind of like Stalin, and then but they have like Christians, Catholics, Muslim.
Yes.
They're most like Yugoslavia. They're like Slavic, but there's a Kosovo is a breakaway state. It's not recognized by a lot of countries still.
Exactly.
And they were like killing each other there. So
Yeah.
that's why it was not UN. It was the NATO. It was a NATO
NATO,
operation
yeah, okay.
to stop like massacring. It was during Clinton
Clinton
time. Yeah, there was like so Biden's son was there too. So like they have monument to Clinton. They have streets named in the name of Biden's son.
Hunter Biden.
Yeah.
Hunter Biden, right?
I keep
Hunter,
forgetting
his
which
name is
one's
Hunter.
which. Is the one that was a nice son, the one that joined the military.
The one that was
That's the husband.
Died from
The
cancer.
one that
Yeah,
died.
the one that got died with cancer.
Yeah, the
other
bad
one
one.
which they were calling corrupt, like which.
Yeah, that is
The other one was like, yeah, he was corrupt, he was
that
doing
is the one,
drugs.
that is Hunter.
Huh? Hunter.
Hunter.
That is
That's not Hunter, right?
We don't talk about him.
We don't know.
Yeah. But it basically, and it's basically a frozen conflict in a way. There's still like shooting at the border. So there's some guys that are like helping out at the border patrol, and they'll get shot at. Serbia had to apologize and everything, blah blah blah. It's just, but it's like we like leave, and it's gonna be people. It's like it's like when I try to explain to people, it's like Ukraine Russia thing. It's just we're standing there, not preventing that from happening. Okay.
Alexi, but then let me ask you this question.
Okay.
Kosovo, is Kosovo a NATO member?
No, they're not. They're not member of anything.
Okay.
NATO, because NATO and European Union.
Wow, it says landlocked country.
Yeah.
Landlocked country. What does
Yeah.
it mean?
But it's
No
very
ocean.
complex there.
No sea. No.
I just googled Kosovo.
Yeah.
First thing I saw under that is landlocked country. Okay, so it's not.
Yeah.
It means like it's like.
There's no
There's no
ocean
sea,
around
yes,
it.
but
that's
it's
what
not
it
something.
means.
But they're trying, so it's primarily Albanian
Yeah,
population.
both
They're ethnic
different
Albanians.
countries.
So a lot of them trying to join
that's good.
Albania.
So
What?
I'm planning to go to Montenegro. That's next to it.
Okay,
Yeah, that is-
listen, we gotta talk
that is-
about this.
Yeah.
Have you ever been?
No.
It's phenomenal.
It's my mom's 70th birthday, so I was
Montenegro-
thinking, me and
Montenegro,
her
these
one
were
week,
all
we'll
the-
just do
these were
Montenegro.
all the countries in the world.
Exactly, but
Yeah.
Montenegro, I went there on vacation. It was probably one of the best times I had. Do you know where you're going?
Haven't even planned.
If you want to talk about this, I don't want to interrupt the class, but Budva is where you kind of want to like Budva, I think, or WA. This is where you want to kind of. There's a nice.
Yeah,
beach.
Budva, that's on the beach side, right?
It's in the beach side. Yeah, you have mountains
Oh,
right
great.
behind. There's like a wall of mountains.
Yeah, well.
Nice roads. You definitely should rent a car. It's cheap.
And easy to drive.
Easy to drive.
Left-hand
Amazing
drive?
road. Listen, you lived in India. Did
Yeah.
you drive in India? You can drive anywhere.
So it's a right-hand drive? I know.
It's
If I
only-
can drive in India, I can drive in
Alex,
India.
Exactly. If you drove in New York, yeah, I actually drove in Kosovo because I'm like close to New York. It's kind of crazy the way people drive there, but I was like, if you drove through Jersey like multiple times, you're fine in Kosovo. Because people kind of like, they like to race as like sports cars,
Yeah,
whatever.
I know. I follow
But
that
basically, go to Budva, and then up there's
high
there's
school
like
at that
Tibat. There's like I can show you on the map. I keep forgetting the cities, but it's so
Montenegro.
yeah.
Montenegro.
They filmed
Have you
Game of.
been?
What?
Have you been?
No.
Have you watched Game of Thrones?
Yeah.
A lot of filming was done there.
Montenegro.
On that, it was Croatia. There's a lot of castles. There's this city. There's like a castle.
So you
and
recommend
it's-
Montenegro?
Yeah, it's awesome.
Awesome.
There's a
right?
great national park there, and it's clean. I never seen where you swim out and you can see the bottom of the ocean by like, and it's like feels so it's like, but it's like 20, 30 meters, And I tried to dive and like touch it. I was like, wow, like, because it's so clean because they have no factories, no production. There's like a aluminum factory, but the Russian oligarch bought it and closed it, so there's a monopoly type of deal. And it's just like it's beautiful nature, good people, there's zero crime. Yeah, you should see the prison. We hired a tour guide, and she like showed us around, and she's like, "Oh, this is their prison." I'm like, "That's how my
Somebody passed it
elementary school
as I was
looks."
driving.
It looks like an elementary. Their prison looks like elementary school. No homelessness. Like you will see some, but it's like mostly not the local.
I mean, we were expecting it.
So.
That's good.
Got into
It's my
Walmart.
mom's 70th birthday. I was
The
saying
class
I'm going to
today,
do
so I
a
didn't
1
go
week
to Detroit.
mom and son trip.
Because of the class.
But why exactly there? I'm just curious.
It's just like somebody, like a friend of mine said that it's really good.
Yeah.
It just stick in my head. I never
Hoping she'll
thought
last
it's
today.
easy,
It's
like
okay.
for my mom
She'll-
not to
she'll
get
manage.
visa.
That
If
is
I
very
have to
easy.
go to
Yeah.
Pakistan,
Yeah.
There's no visa.
There's no visa in Montenegro.
It's amazing. So we met with my parents. So my parents, because they're from Belarus, sanctions, all this other stuff.
Yeah, no, I mean,
It's
not
easier
like
for
last
them
week,
to like
she
from the
traveled
war
with
zone
us.
to fly.
Yeah,
and
that's
so forth. Like we meet there. We're actually
85.
planning, thinking about meeting there in August, either Istanbul or Montenegro. I'm trying to convince some like our whole family to meet in Montenegro. And this is the
Sorry,
time.
I'm distracted.
This season, this is kind of like it starts in May, like it ends like September.
I mean, look,
Past
this
September
generation
15th,
disappears.
restaurants
This is.
Oh, so I'm thinking in that time.
She's trying to go before September 15th. It's still beautiful. It's beautiful warm weather. But like the thing is, it's like they're like culture. They work only in summer. The rest of the year, a lot of them don't.
May through September.
Yeah. So like maybe September, maybe 15th, maybe 20. I need to
Where you
look up.
from?
Maybe very similar to like these Martha vineyards, like this.
Because I went there in September and literally like the last days it was like, but then again, you don't kind of, it's just the restaurants closed, it's kind of scaling down, but there's still a lot of stuff to see. And there's a national park. I'll try to figure it out. Next time, try to get notes.
Alright, now that
Yeah.
their
I'm sorry,
vacation
can we
plans are
grab
done.
coffee real quick?
Yeah.
Yeah, yeah.
So,
So you need a visa.
Not my mom.
European Union?
My mom.
Oh, your mom. You need New York.
She has Schengen visa.
Otherwise, you have to back up Croatia.
Yeah, that's the whole thing.
oh, it's not recorded.
Sorry? Yeah, I saw a few games. Like, I was watching the scorecards. I was not actively following. I know Ashwin is playing this year for MLC. I don't know if this is Texas. Right? I did not follow that, but I was following this. I'm gonna follow this Ireland game. This new sensation that was showing. I wake up even at 3 a.m. to watch his games. He's like one of the top players.
He is ruthless.
Ruthless.
So this is the last.
Have you heard of this guy, Ramesh Suryavanshi?
What, cricket?
Yeah.
I don't follow cricket, man. I only see once a year World Cup. I don't match on
I
World
think
Cup.
in the tri-series of Sri Lanka, India and Afghanistan,
He killed in the final. 29 balls, 85,
29 balls, 94.
94.
The Indian guy?
Yeah.
He's a 15-year guy.
15 years. I've heard about it.
Even younger than Sachin.
Yeah, I've heard on the WhatsApp groups that.
They're saying he will be even better than Sachin and Kohli combined.
Wow.
That's what they
He's a
said.
left-hander.
But they said the same thing about Prithvi Shah as well.
Yeah, he's not consistent in his practice.
He's Vinod Kambli.
Virat Kohli was really good. I mean, better than Sachin.
No, Sachin was. So I started watching games in 1992 World Cup. That was my starting of watching games. Because my father used to watch games, I would sit with him. At that time only there will be 1 or 2 channels you can watch, not many. So I hooked on to cricket. And since then I've seen Sachin from 1992 when he was like 20.
Yeah.
He was.
Yeah? Okay. Maybe.
I still remember his first game.
Hmm.
It was 6 a.m. He was playing New Zealand as an opener in New Zealand. That's how he started opening.
Yeah, opening it.
That's
I
what I remember.
used to watch. I mean, I was in India.
He gave us the most joyous in sports.
Yeah.
Okay, should we start?
Yeah. Now you're ready.
Yep.
Let me know. Guys, come on over. Run.
Let's put that on.
Yeah.
Minimize.
Run with us.
Just minimize.
This one.
Probably have to.
You can do this?
He's the only one standing there.
Yeah.
What chapter of the book is this in?
So we know, so that's good. Let's jump to the end first. So chapter 5, 17 and 21. Again, I'm talking more in the 4th edition. Right, so chapter 5 will talk about XVA. Chapter 17, like out of the XVA, we will talk about CVA. There are other chapters 18, 19 that will talk about FVA, etc. I'm just highlighting the key ones that we are discussing. XVA, CVA, and then there is a 21 chapter, actively managing XVA and the role of XVAs. Okay, but in the CVA, you will also get the stress testing, the wrong errors, that will be all part of the chapter 17. Okay. So from here, what we did, so with whole CVA, so what we said is, if you remember this calculation, we said it's EPE multiplied by PDE multiplied by LGD, right? So when you multiply, you're assuming these are independent variables, right? That's how you do. If you're assuming all these 3 variables are independent, you're charging for expected loss, assuming these are independent. That's a CVA assumption, a simplistic assumption. Now they've started building more correlations, but the most dangerous counterparties are often those where the credit quality deteriorates when our exposure is the highest. So you're saying when my exposure is increasing, but at the same time the counterparty quality is also deteriorating. You can have a scenario where my exposure is increasing but counterparty strength is also increasing. That's the right way risk, right? But if I'm saying where the exposure increases but the credit quality of the counterparty also deteriorates, that is what you call as wrong way risk, and that is the most dangerous. You don't want to get into transactions with counterparties where you know that when my exposure to this counterparty will increase, their capacity to pay me will also diminish. Right? That's a bigger risk, right? So let's take this example, right? So where let's say there's a corporate A that does a trade with a bank, a reverse repo. How many people know what a reverse repo is?
Say it again.
What is a reverse repo?
We talked about neutral asset class. So it's like overnight rate, but reverse one.
So there are 2 types of transactions. So we talked about derivatives, then there are repo transactions. A reverse repo is where you are providing funding to a counterparty. So they pledge their assets, you give them funding, and they pay you a rate, and that rate is OIS rate, repo rate.
Got it.
Right?
Okay.
A repo is, yep.
Who would be that? So it's a bank that does the repo.
So it
Right.
can be either way. So if I'm the bank, if somebody is holding asset, they need funding, they don't want to sell their assets, they will pledge their assets
It's a collateral.
It's a collateral. It's called secured financing transaction.
Correct, yes. that
Right?
one I
Secured
know.
financing transaction. You will pledge your security rather than selling it for liquidity, and you will get funding. That's called reverse repo. So, a bank. So what is reverse repo and repo? Repo is a repurchase agreement,
Yes.
right? Reverse repo is a reverse repurchase agreement, right? I will talk about this first, like reverse repo, then we will get into repo. Reverse repo is, yep. go
One
ahead.
more question, and this is because I thought repo was like short term almost, so it's a very short term,
Yep.
they're like basically have a cash flow, they say, we're gonna give it back to you in like what, a week?
A week or a month, it's generally less than 12 months.
Got it.
Right? So otherwise it will become a loan, a collateralized loan.
Exactly,
There's
that's
a
what I thought.
difference.
It was like a secured loan.
Yeah, it will become a secured loan. This is not secured loan because they are done under some specific type of legal agreements which are called master repo agreements. So there's a difference. That's why you keep it under 1 year, so that it does not become a collateralized loan. It has a different meaning. So reverse repo is, let's say in this case, a bank is providing funding to a corporate, and corporate is posting its own bonds. So let's say it issued some bonds in the market, right? It's posting its own bonds or its like affiliates bonds. But what's going to happen? So let's say so in this case the bank has given them the cash. It's holding on collateral, which is the corporate bond of this company. Right now, if credit quality of the corporate deteriorates, that means that now counterparty is getting deteriorated. That means that its bond is also getting devalued in the market. Right? So what you are holding now for the funding is also worth less.
Is it a bond or a note?
It can be mostly it's bonds.
Okay.
Those are more, but some people also do repos and structured notes.
Correct.
You can do a repo on anything. You can do repo on US Treasuries,
Oh, you can do 10
corporate
year.
bonds, right? You can do on CLOs,
Mm-hmm.
MBS,
What is MBS?
mortgage-backed
Mortgage-backed
securities.
securities.
Right? So whatever asset you are holding. So let's say whatever is in your pocket, whether it's gold, whether that's silver, you can pledge it and get a funding. Right? So let's say they were holding their own corporate bonds, they pledged it. Now, if counterparty, so what happens is, if, let's say the quality of the corporate decreases, their bond is also worth less. Now, what's happening is, I have like the bank has exposure to the corporate because the collateral I'm holding versus the loan I have given. If the collateral is less than the loan I have given, but at the same time now I have the exposure to the corporate, but now that corporate is also very risky, right? So that is wrong way risk, where the exposure to the corporate increases, but at the same time the corporate's capacity to pay me also deteriorates. That's the and this is what's called very specifically. This is called specific wrong way risk. Okay, so most of the banks, like at SMBC, in our policy, it will be we will not get into transactions where you have a specific wrong way risk. It
Say
will
it
be a
again. I'm sorry, which risk?
specific wrong way risk. So you see this specific wrong way risk. There are two types. The example we are talking about is specific wrong way risk because there's a direct linkage between the transaction and the counterparty credit quality. Because the transaction has the bond of the same corporate, it's a specific. Right? So in this case, what's going to happen? So in banks, you will not say if some counterparty comes to me and say, oh, I want funding, but I will pledge my own collateral, or I will post my affiliate corporates. You will say no. We don't do that. Right? So until unless it's a very profitable business, like for you, that's corporate relationship is very important. You may get some exceptions, but it has to go through exceptions. You cannot just take specific wrong way risk. Many firms will not allow that, right? Because it has a lot of capital implications. The cost of doing this business is very high. You cannot, so you have to show this mentally, like on your balance sheet, you have to show this as a loan, because you can't give the benefit of the corporate bond that you're holding. So for you, it becomes a loan then, and it has a very high consumption of capital. So the banks will not get into this. They will say, you know what, it's not worth it. I'm just charging OIS rate. I'm blocking my full $100 million notional. I'm selling it below my cost. Right? So that is like, so wrong way risk occurs when the exposure to the counterparty increases. At the same time, the counterparty credit quality also deteriorates. Right? So this is a specific wrong way risk. But there's also a second type of wrong way risk, which is called general wrong way risk. where the exposure and the credit quality are affected by the common market factor. And we will talk about those examples, right? But essentially, this type of interaction of wrong with risk is not captured in the expected losses, because in that you are assuming that your EPE, PD, LGD are independent variables. There is no linkage between PD and EPE. So that's why wrong with risk becomes more difficult, and this is where we will see if this is not captured in expected losses, you don't charge the client on these things, then how do you manage it? But this is, we need to understand from CVA there was an assumption, but as soon as you start getting into wrong with risk, that becomes more complex, and you need to manage this wrong with risk. Okay? Now let's talk about few examples. Like, so we talked about specific wrong with risk, right? So where a counterparty, like reverse repo transaction. Now let's talk about another specific wrong with risk. Let's say you buy a protection, a CDS, credit default swap, from a counterparty, right, for its own. So somebody is selling its protection on itself. So they will pay you. So in this case, the credit default mark to market will increase as the credit reference entity's credit deteriorates, but that's the same entity you purchase it from. So now there's a protection seller becomes more likely to default. The hedge provider may fail precisely when the protection is needed the most. Another example, you are getting into a equity derivative with a shareholder. So let's say you go with Elon Musk. He posts his like Tesla shares to you as a collateral, and you're giving him funding. You're getting into wrong risk over there, right? Because the exposure as the stock price will fall, your exposure is increasing. At the same time, the wealth of Elon Musk is tied to that same stock. You have double the risk. Okay? Now let's talk about general wrong risk. Like in this, let's say you're doing an interest rate swap with a BBB interest rated corporate. Now let's say when the interest rate movement happens, that changes your derivative exposure, but that economic slowdown also weakens that corporate earnings and credit quality. Now your exposure is increasing. At the same time, when economic slowdown happens, again, it's not specific, like as we talked about in the stock, but there's a general risk factor, which is interest rate, which is tied to the exposure, but it's also tied to the quality of the counterparty. So your exposure and PD increases due to broader macroeconomic conditions that again introducing you to a general wrong risk. Okay? Let's say same with the FX portfolio. Let's say there's a corporate out of UK. Now, so there's an FX portfolio where with this corporate where the market volatility increases exposures when the credit spread widens for that country. Right? So now the counterparty, so let's say if a UK bank is doing a transaction with you where they are long GBP. Now when there is some kind of macroeconomic stress in UK, that counterparty, let's say Barclays, is in a bad condition, but your exposure to Barclays is also increasing at the same time. But it's not linked to the underlying specific stock or a direct linkage. It's mostly connected with the depreciation of the currency where the counterparty is incorporated. So again, yep, right.
So basically, the wrong way risk that the product basically, so they're making the repo, right?
Reverse repo.
Reverse repo, and when the value of that loan is between Barclays and British Bank, whatever, if the currency drops because they're long, there's that difference comes up.
So let's take this example.
Yeah.
Let's say Barclays
Yes.
posts you UK bonds
Okay.
as collateral,
Mm-hmm.
right? Now you're giving them funding. Now let's say broadly UK.
The interest rates go up in the UK.
So even let's say there's economic deterioration in UK.
Yeah. Okay.
Now the UK bonds are worth less.
Correct.
Now I have exposure to Barclays because the loan I have given
Yes.
versus what I'm holding
Collateral is
is
basically
is less valued.
But don't you?
But at the same time,
Mhm.
the country is the company is also based out of UK.
Mhm.
it's also going to affect the company's health as well.
Of course, I understand.
Right? So you have a general wrongway risk in this case, where they posted a bond, a UK bond, and the counterparty is also incorporated out of their risk, is also out of that same country. You have a correlation on GBP.
Yeah. Can you hypothetically write in the contract that if there's a difference, basically, you know, same thing with like stocks, when you're shorting stocks, right?
Yep.
On the leverage, so you know you have to come up with a difference, right?
Margin.
Margin, exactly, right?
So these repo products are daily margined.
They what?
They're daily margined.
Okay, got daily, right?
They're daily margined. That's the
So
reason.
Barclays has to come up with buy more bonds to show as a collateral. But you're saying
They have to give you more bonds
correct,
because the collateral they posted is worth less.
correct.
They will post you more bonds, but let's say they don't come and give you more bonds. They file for bankruptcy.
Then,
So now I have more risk because when the UK bonds got depreciated, the counterparty risk has also increased. But because that counterparty is based out of there. Yep. Okay.
so you said HSBC does not deal with those, or SMBC?
SMBC. So we do. So this is general wrongway risk. That's fine. Specific wrongway risk I will not go. Where Barclays will post the Barclays bond to me.
Mm-hmm. Got it.
That I will not take. That's very risky. And that's risky, one, and two, it has a very high capital consumption. Because I cannot recognize, as per Basel rules, I cannot recognize that collateral on my balance sheet as a mitigant.
So who's dealing with those?
They're very few. They will take very high. They will charge them very high.
Yeah, but which banks? Like, is there banks like?
Some take the wrongway risk if they really want to do that, right? But not many banks will get into specific wrongway risk. So the people who will do this, they will say, oh, you know what? I will take a 50% haircut on the bond. So if I'm giving you 100 million, you need to post me $200 million bonds,
That's insane.
right? Because I need to take a haircut
Yeah.
to cover for, because if this 200 goes down to 100, at least I'm little covered. So I need to charge for higher margin. So when Elon Musk will post its own stocks, Tesla stocks, so Musk does not sell his stocks, right? Because if he sells, he will have to pay capital tax gains.
Correct.
What he will generally do,
None of those people do that.
Yeah.
They take loans.
they take loans,
Yeah.
but they will be doing a
Like
fifth,
collateral, and then
yeah, they will be doing 30-40% haircut.
Mhm.
So they will post the double because they're holding anyways in their account. Right? That's why the margin on those will increase significantly, because you have to say if you're taking that specific wrongway risk, right? I know like for like Bank of America, Citibank, they give loans to Musk
Mhm.
on the back of their, and those are called margin loans.
Mhm.
But there's a wrongway risk. They will charge higher haircut to compensate for that wrongway risk.
But it's cheaper than paying taxes.
Yeah.
I guess.
Yes. Okay. So, and they may be fine to pay more, post more collateral.
Yeah.
Anyway, so this is like, so the reason, again, so this is what, it's not captured generally when you calculate CVA, but this is a major risk, right? And most of these wrongway risks becomes more evident in stress scenarios. So besides the expected loss, what you do is you run stress testing, because wrongway risk, etc., are not captured in the expected loss you are charging, right? You need to run the stress test to understand what your exposure could be. Let's say for this example, let's say in a normal market condition where the EP was 120 million, PD was 2% and LGD was 60%, you charged an expected loss of 1.4 million to the counterparty. You charged, let's say, 20 bips to the counterparty to compensate for this loss. But what could happen in a stress scenario, this current exposure, which is at that time, your exposure can jump from 120 million to 500 million. At the same time, the probability of default of the counterparty can also increase. The LGD, even if you assume the same, the loss you are looking at is 15 million. If you multiply the 500 million with 5% with a 60% LGD, you are looking at a potential loss of 15 million. But when you charge the client, you charge it for 1.4 million because you were charging for the expected loss. But the actual loss will be very different from what you are charging over the life cycle, because that depends when that loss happens. And at that time, what's the probability of default of that counterparty, right? So stress testing allows you to look at these evaluations where you will start shocking. So you will say, you know what, this is my current scenario. Let me see in some historical scenarios like Lehman Brothers crisis happened, global financial crisis happened, COVID-19 happened, how much of this my exposure will change? So I know what I charged, expected loss, but I need to complement it using stress testing and see what my losses will look like, right? Because for those losses, then I need to think about that how will I manage those losses, because this will not be enough, what I'm charging them. But I cannot charge them more based on the loss, and we will talk about that. For the potential of happening this, the probability of happening this stress event is very less. You cannot charge a counterparty for a very less probability event. You're charging only 1.4, but you may have to cough up 15 million for this loss. Now, you have so what banks do generally, they will have plausible and severe scenarios that they will look at. Like, standing here, this is my EPE, but let's say what in a worst different scenarios, what this exposure will look like, right? And in that case, they will come up with their potential loss, and then they will think about how they want to manage this potential loss, right? So think about this. So let's say for credit, I'm fine giving a counterparty a $2 billion limit. Let's say if a big corporate like Verizon comes to me, right, and say, I want to start trading a lot of interest rate swap, FX swaps with you. We will give them a $2 billion limit. Like, think it as this, like, where they can trade. As a bank, I'm fine looking at their financial statement saying they have the capacity to pay me $2 billion. So I'm fine extending this credit to them. This is very similar to if you go to American Express and they give you a $20,000 limit based on your income, right? Because they know that you have the capacity to pay $20,000 over time based on your income. As a CRO, do you think if the stress exposure for this counterparty increases from 300 million to 700 million, CRO will care? So in this scenario, you gave a $2 billion limit, right? You gave a $2 billion limit. You're saying, I'm fine till 2 billion. Let's say right now the exposure is 300 million. If it jumps to 700 million, do you think a credit risk officer will be concerned when he has approved $2 billion limit?
Yeah, because we went from 300 to 700, can go higher.
Right?
We went from 300 to 700, we can go higher.
But it's still
Because
within 2
there's a
billion.
trend.
But he's fine with till 2 billion.
Huh?
He's fine till 2 billion.
Yeah, but like.
He gave the limit.
Yeah, but there was like 300, but now it's 700. So what is going on? Why did he act that? The question this year should ask why now, right? I guess there's.
So let's say it goes up because in a stress scenario. Let's say today I'm looking at $300 million exposure to the counterparty.
Okay.
In a stress scenario, let's say it goes to 700 million.
Okay.
Right? When credit has approved that we are fine till 2
The
billion.
rules are set.
Yeah, you have already given, you know the counterparty has the capability to pay me 2 billion. You have given that, hey, I'm giving you a limit because I know how you earn. You can pay me 2 billion. If my exposure goes up in a stress scenario from 300 million to 700 million, do you think a credit risk officer should be concerned?
No,
Why not?
because it's like, as you said, 2 billion, right? And it's not, it's not half of that, or more than half.
So he's fine, right? But he may ask you
Why?
why and what is the implication of this from capital point of view,
Of course.
right? Because he
Which I
will say,
mentioned in the past, like, when I said, yes, be concerned, but now I see what you say.
but because if the stress exposure increases, the firm has to keep more capital on the side. He may say it may not be a risk issue,
It's a utility issue.
it's a utility issue. How you deploy your balance sheet. Because now you're taking, earlier when you thought you will keep, let's say 500 million for this client, now if all of a sudden you have to keep 900 million for this client. You have to take it from other projects which you could have generated you income. It's an issue. It's a balance sheet deployment utility issue. Can we go to the next slide? You need to help me. Okay. So this is where we will talk about what stress losses tell you is unexpected losses. Because expected losses you already charge the client in CVA. Right? So let's say where you start today, for a single counterparty relationship, let's say at the start you have $100 million EPE, 2% PD, LGD 60%, 1.2 million. But what can happen in various scenarios? If the probability of default not happening, let's say that's in this case, if the probability of default is 2%. That means the probability of not defaulting is 98%, right? So what do you mean is, like, in that case you will not have a loss. But there's 1.5 out of that 2% when the probability of default can happen. If that default happens in a normal condition, the chances of happening that kind of a default, let's say it's 1.5%, you're looking at a loss of 20 million. If it happens in a stress event, where the exposure increases, the chances are less, 0.4%, but the loss will be higher, 40 million. And in a very extreme scenario, where you have a default and it's a severely wrong way risk, the chances of that happening is very, very less. But the loss you are looking at is 60 million. You can have various outcomes for a given counterparty versus what you charged. What you charged was expected loss. But you are looking at an unexpected loss, even though the probability of that happening is low. But if that happens, even 1 in 50 years, that's going to blow you up. Right? So in this case, which event will threaten a bank solvency? Many small expected losses, or one large unexpected loss, which they never accounted for? Big one, right? That will make them liquidate because they never had that capital, right? So when you only charge 1.2 million, who absorbs that additional 40 to 60 million loss? You still need to keep some capital on the side. You had a balance sheet, you had an asset, you keep the CVA reserve on the side, but that's not only going to cover you till 1.2. You need contingency funding capital on the side, so that if big loss happens, you don't have to start like selling your assets.
This was Lehman Brothers.
Yeah, this was Lehman Brothers. That was the reason, because most of the banks, then when these things start happening, then it will cause liquidation. Right? Because if they have a loss, they don't have the capital. It's going to start they need to start liquidating their assets, because they still have to pay their liability. Because their asset was, let's say, 60 million, which now is a loss. Your liabilities are still the same. You need the capital to absorb that loss. Otherwise, you need to start defaulting on your liabilities. You can't pay those liabilities, right? So, Sanjay, go to next. So this is where, like, when you charge from exposure, EPE, CVA, you start moving to capital. In capital, what you do? It's a 5-step process. I'm going to simplify this, right? So what they do is, you have, let's say, in step 1, you know what the current exposure is, you know what the EPE is, you know what the stress MTM looks like, right? You are already calculating using the stress testing, what the stress loss looks like. The regulators require you, in step 2, they require you to keep some capital on the side, because they need to contain the systemic risk. Because if one counterparty goes down, they don't pay on the liabilities. The counterparty whose asset was someone's liability, that asset will be marked down. It will become a systemic event. What regulators will ask you, they will say, we will prescribe that you need to keep capital on the side. Besides that 1.2 million that you were charging, which is average expected loss, there's a calculation which is called SACCR, Regulatory Capital Standardized Approach to Calculating Counterparty Credit Risk Capital. That uses, and I'm not going to get too much technical into the calculation, but what it's going to do is it's going to take your current exposure, which is at the top, 100 million, right? And it's going to add a PFE add-on, a tail risk kind of a component, which, let's say, is 150 million. So they're going to come up with with exposure at default, saying you have a current exposure of 100 million, and we know we have a tail risk measure, which is another 150. Your total exposure at default is looking to be 250 million, not 120, what you are expecting as an expected positive exposure. And now, based on this, they will say, so this is your exposure at default, and let's say your risk-weighted asset, your EAD, exposure at default, and your risk weight. Like, if this is a high-risk asset, they will say the risk is like close to 75%. If it's a medium risk, they will say 50%. If it's like a sovereign, they will say 5%. Right? If it's a sovereign fund, if it's a US Treasury, Fed, they will say the risk is less. But that is how they will say, like, this asset that you have of 250 million, you need to calculate based on the risk weighted average. If it's full risky, 100% risky, you need to keep 250 million as risk weight asset. If it's half risky, you need to keep to 125 million. And based on this risk-weighted asset, they will say you need to maintain a margin which is 10% as a capital reserve on the side. So think it this way. You are projecting as a CV desk, you are projecting that asset to be 120 million, right? This expected positive exposure, right? What the regulators are saying that what you are estimating as your risk as 120 million exposure is understated. Let's look at what that risk could be in a stress scenario, and that is going to give you 250 million. Even if I say this is not full risky, it's a good, decent rated counterparty, that risk-weighted asset becomes 125 million, and you need to keep 12.5 million on the side to absorb for any losses that will come from the unexpected losses, which is the stress testing. Because for the expected, you have already kept on the side from the CVA charge, right? Now, this 12.5 is the capital that you need to keep aside, what shareholders' capital, that you need to give them returns. If you remember, we said there's a cost of capital, right? How you come to that capital? This is the way you come to capital, that if you do this kind of trading activity, how much capital it's going to absorb of the shareholder. And shareholder is saying, if you're absorbing my 12.5 million, I'm expecting a 10% return on my capital that I'm deploying with you, right? So you need to generate 1.25 million as a return for me on a per year basis. So this is a linkage where you start, we go to the next slide. So if you now start connecting the dots, right? So we started with pricing CCR. We talked about credit valuation adjustment, how you price that into the transaction. We talked about the building blocks of how you calculate that charge. Then we went into, there are more costs, not just a CVA. You have XVA, funding cost, capital cost. Then we also talked about what's the role of XVA desk of managing that, what you're charging. You need to make sure that you are managing that P&L. But then this is just expected loss. You can price that, but there's a tail risk that can come from a wrong way risk, that can come from stress testing. So there's a difference between the expected loss that you're charging versus the unexpected losses that can happen for this transaction. And you need to capitalize these unexpected losses as well. That's your capital requirement. Is that clear now? Like, we went through few complex topics today, but I do want to connect them together. What we talked about. Any questions? Because it's a very pretty interesting linkage when you start looking at things. Starting because this will combine all the three worlds, right? So the first binary we talked about CVA. Second, from the risk standpoint, where I'm looking at stress testing, wrong way risk, etc. Then there's a third lens, which is the capital lens, where we need to make sure the capital is being managed appropriately. And you are generating that return, otherwise there's a cost of deploying the capital from the shareholders. You need to make sure you're giving them enough returns. And that mostly comes from the tail risk. A lot of, so sometimes what happens is, when a deal comes in, you will price, hey, I'm going to charge 20 bips on this transaction. The rate I will charge is 5.2. And I will calculate what is my ROE. Based on that 20 bips, I will say 5 bips is going to CDA, 15 bips is coming here. This capital I'm keeping. My rate of return is 8%. The businesses will shut it down. They will say, no, our hurdle rate is 10%. You can't do this trade. So that's how you select your trades. So sometimes, a lot of these trades, which are really heavy on capital, they get turned down because you will look at how much capital you have. There's limited amount of capital. You want to deploy it as efficiently as you can to generate the maximum ROE. So sometimes what will happen is now, recently I'm in discussions for some counterparties where capital requirements are higher. We are forcing XVA desk to start hedging, buy more CDS. If you buy more CDS, you can bring the capital requirements give you offset for the CDS. Because it's saying you have a expected loss at default from the tail risk, but if you can show me mitigation from CDS, I can give you that benefit towards the capital. That's where XVA again comes into picture. If some deals will get turned down, they will say, you know what, we will buy a CDS, we'll make it light on the capital. I know today was a little complex, but we were building up.
So,
Yeah.
the first pillar, I'm trying to
Yeah.
summarize what I understand is the first pillar of pricing CCI is for working with client, right? And then you say that the valuation things are related to the balance sheet management. And when we try to manage the tail risk, we try to quantify it, and then we, quantify to take the action to hedge the risk or to manage the, so the next step is capital management, right?
Yes.
So basically it's for internal risk management at the bank.
Internal risk management also for the capital optimization.
Okay.
Right? So one, yes, we are managing our tail risk, but ultimately if tail risk is high, understand there will be have like more capital requirement. And if you are not hedging that capital requirement, you will generate less ROE. So think at this way, right? So let's say at the initiation, we entered into a transaction and we kept some capital on the side. Stress event happens, you are keeping more capital on the side now.
So when you're talking about ROI, so it's a return on investment.
Equity,
Oh,
ROE,
sorry.
return on equity. So we are talking about shareholder capital, which is equity. So you have to generate, so any transaction, this is like basic, like if you go one of capital kind of planning or like corporate finance 101, in the first course they will teach you that there is IRR. You remember what IRR is?
Internal rate of return.
That's your hurdle rate. In this case, that's your ROE. You need to meet that IRR, that ROE, for the capital to be deployed. Because you will say, if I have 10 projects, one has given me higher IRR, you will definitely go with that, right? So you really need to make sure that you are using your capital for the high ROE initiatives or deals. What happens is generally in a bank, let's say you have a balance sheet and let's say a shareholder capital of let's say 1 billion, right? They will say for the derivative business, I will give 500 million. I'm just making it up, right? So let's say that is like 1 billion is too less. Let's say they have 50 billion in capital. Out of that, they want to give 10 billion to derivatives. Now, you can't trade with all the counterparties in the world. You want to make sure you're trading with who are consuming the minimum capital and giving you the maximum returns. That's your like last capital requirements, right? So that's where you're trying to understand what my capital requirement is. I will only do the trades which have low capital requirement and they generate me good returns. Any other questions? Did the lecture make sense today? Alexa, you were not in the first interval, so it did not make sense.
No, it makes now.
You were the first one saying yes. You were the last one saying yes.
It's so quiet here, it's sad, I wanna talk, I wanna make it interactive, you know.
It's a good
If I
spirit.
didn't say anything, we would have waited for 5 minutes.
Just being nice.
You are the life.
Thank you.
Okay, so I think in the next class, so I think that concludes our class today. In the next class, we will have a quiz.
Yeah,
So
should
you
we
have the
start,
quiz.
should we start with the quiz or will we have a class and then the quiz?
Let's start with the quiz.
Okay, quiz is your final exam.
Is it 20
20
questions,
multiple choice
choice?
questions.
On everything.
So this is whatever I taught in the class. So
Yeah,
if
I'm
you
gonna
read all
upload
the
that.
lectures,
Yeah.
you will be able to answer that. You just need to go through the lectures.
And last
So
class-
nothing is out of syllabus.
Yeah, that's the last class next week.
Wow, sad. I
We're done.
really like this.
It's gonna be on paper?
How you want to do it?
Yeah, unfortunately we have one student who has to do it online. So now we have to do everybody online.
Okay.
So which means this weekend I have to type everything out. So
You have
that
all,
works for me.
you have the questions.
Yeah, I have the questions, but we need to, that upload feature never works in Husky, so I have to type them out. Man, I'm underpaid administrative assistant.
Pretty sure you can reach out to some other.
So give it to someone who can.
Why you just take
Who's gonna
a
help me get the questions ahead?
Why you just take a photo, you upload to ChatGPT as to file the text, and it will have a text.
Yeah, unfortunately, the CSV files that Husky needs me to upload in they're so complicated. I do CSV, just won't accept them. You know, it's like, have you tried? I don't know anybody tried as a PA. So last time I had to type everything up. I'll try again. I'll use ChatGPT, do the data, try ask it to create the CSV and then upload to Husky. But anyway, we'll have it on Husky. Bring your computers. It's 20 questions. I want to make sure. Oh no, let's not record this part. How did I not do that?
Right.
Yeah. You know, because this whole 5 sessions have been created, so I've had, last minute.
It was really good. I think this really helped you, by the way.
Yeah.
I like the examples and the subject matter experts, so it's really good.
Yeah.
Thank you.
And, we try to give you as much information as possible. I don't want to make the exam hard or make it any way difficult for you guys. The question is, if you don't read anything and if you get 19 of them wrong, how do I do this? I want to make sure everybody does well. So we need to figure out an algorithm as to, I'll definitely curve it so that you all, get good grades. But if there are outliers,
It is what it is.
maybe we'll do another one or something. If there are no outliers, we'll call it a day. How about that? Okay?
But if you go through the lectures, go through all the discussion questions. If you can answer those discussion questions, you should be able to answer the quiz. Let me put it this way.
So no calculate.
Right?
So no calculate.
One or two, but more will be conceptual. If you can go through all the lectures and you are able to answer all the discussion questions, you should be able to answer.
Alright, we'll see. Because it's on Husky, the result will be immediate. If there are outliers, I'll try to do something for the outliers. How about that?
So we need to go through the slides and what the actual slide, right?
If you can answer those
Yeah.
and go through the slides, you should be able to answer them. Not like those questions will not be exactly there. What I'm trying to say is that the
on
essence.
the slide, that's what
Yeah.
questions you need.
Yes.
What in a book, on the slide.
Okay, so,
If you have, so, open book, closed book, there's a multiple choice.
multiple choice, so the answers are right there. The thing is,
How much time, if you want to keep open book, I'm fine, but like if, that will make sure that you read the book. You open that book.
No, but they can see your deck slides, right? That is the question, some of them will be obvious.
Which questions?
Your own slides will have all that.
Yes, that's fine. But then, no, it doesn't have the answers.
Okay.
So again, I'm saying these are not the same questions.
Okay, then we could.
They are related questions,
Yeah,
but
it's
if you
open
can
book,
answer
yeah.
those in
Yeah, that makes my life easier. Open book.
So this will be at 7 next week, right?
7,
Yeah, we'll start a few minutes later because I want to set everything up, 7:15 maybe.
and then, I think how long it will be?
We'll give it 45 minutes for the
And we will do 1 hour.
8 o'clock, we'll finish the lecture.
And I'm more than happy to answer any questions you have after that quiz, even like over the last 4 lectures, or I can go through one more half session where I will start linking the whole world together.
We'll figure that out next week.
So there's the last class.
Yes, last.
Technically, it's the last class. We're only supposed to cover five sessions. But if I want, I can add another one for the exam. I just decided to keep it on the 5th session so that you don't have to come back
Easy.
here.
I love it.
Yeah. So if you really want another session for something, we can do an online one if you want.
No, it's okay.
It's okay.
Joking.
Yeah, we call it. Although, I don't know if any of you are taking my class in the fall. That will be full.
Yes.
You're taking the 1.5 session. 1.5.
Oh, the credit in the hack one? No, I'm not sure.
Yeah, that's the issue. If you don't take that, the full 3-session one won't make sense. This is the problem.
The thing is, again, it's way because of I did the SMF.
Yeah.